We like this. We'd love to see the Santa Claus rally continue. And I think the ability of equity markets to climb the wall of worry should not be underestimated.
We could end up with a good year, not a great year in 2022.
2022 is going to be all about stock picking. We're going to have to be a lot more selective.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
Good Wednesday morning from Berlin and New York on this, the 29th of December. Our top stories today are no sign that the pandemic is slowing down. The Omicron variant has pushed worldwide coronavirus cases above 1 million for the second day in a row. Traders are cautious after that Santa Claus rally earlier this week. Just how big an impact will Omicron have on the economy? European and U.S. stock futures are higher. And Elon Musk closes in on his target. The world's richest person sells another $1 billion of Tesla stock. Musk is near his goal of offloading 10% of his shares, and he will become, he says, the world's largest taxpayer as well. Welcome to Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Kailey Leinz in New York. Anna Edwards is off this week. So, Kailey, we had a little bit of a reversal of the rally yesterday in the U.S., faltering tech shares leading through to Asia, and now we're seeing a little bit of tech weakness here as well. What do you see on the boards?
Yeah, it definitely was a weaker handover from Asia, but they may have just been playing a bit of catch up to the relatively small declines we saw in the U.S. yesterday. Overall, the MSCI Asia Pacific Index fell about 0.5%. China, though, was a big underperformer within that. The CSI 300 down about 1.5%. Now, part of that is ongoing concern around Chinese tech stocks, regulation in that sector, but also more broadly, the threat of the Omicron variant and, of course, the slowdown in the property sector. Now, I also wanted to point out to two dynamics in the FX market. One is that your more risk-on currencies in Asia, the likes of the Philippine peso, were the big underperformers overnight. The Philippine peso actually weaker against the U.S. dollar by a full percentage point at its weakest in about 3 months. But then also the dynamics with dollar yen. No real bid for that safe haven yen. It is weaker against the dollar by a little more than 0.1% and actually had a taste of 115 for the first time in about a month. Now, here in the U.S., we did not get that 70th record high of the year for the S&P 500 yesterday. We closed just about 0.1% below that record. This morning, though, futures are up by about 0.25%, so we could be looking at a record today. We'll see if these gains in the future session can hold throughout the day. They, of course, did not yesterday. Right now, we're sitting at 47.89 on S&P futures. In the bond market, no real movement to note. We are essentially flat on the 10-year Treasury yield at 148. The dollar is stronger broadly in the G10 space and against Asia today. And then finally, I just wanted to point to WTI, basically flat today, just under $76 a barrel, but of course hovering around its highest in about a month, Matt.
Yeah, holding near the 1-month highs. That has to say something about how investors view the hit that Omicron will give to demand. Look at this kind of bummer of a European map here. No real direction. You have big gains in the UK. The FTSE up more than 1%. The DAX here in Germany down about 0.2%. The IBEX down about 0.3%. But a really mixed picture. If you take a look at the Stock 600, you'll see that we are hovering near records on that benchmark index, 489.61. The record, I think, is 490 and change. The euro coming down a little bit as the greenback gains against most other major currencies. So you see the dollar up against the euro, the dollar up against the pound, the dollar up against the yen. Brent crude, the global benchmark, is actually up a little bit, but still relatively flat. To Kailey's point, it's holding near its 1-month high, and I think that's a pretty interesting indicator. Bitcoin is up today, but below 48,000, 47,896. Bitcoin is down 16% so far in December. That makes it the worst month for the cryptocurrency since May, as investors maybe unload or deleverage a little bit, according to Ben Emmons from Global Medley Advisors. Christine Aquino, who helped lead Bloomberg's market coverage out of London, joins us now to talk about what's going on. In terms of risk sentiment, Christine, does it look like we're seeing investors taking profits? I hate to use that phrase. I learned it as a stocks reporter 20 years ago. To plug in places where I had no idea what's going on. But to take profits at the end of the year seems to be like a mantra. And we have had a decent run up.
Absolutely, Matt. And I think, in the absence of any major changes in terms of the macro drivers that investors have had to deal with, right? I think that is basically the path of least resistance, is going with these moves higher. We're seeing that both in the U.S. as well as in Europe. We're headed for another record high over here in the stock 600 in Europe, as you probably saw. And I think that's very much the feel. Closing the books for this year, heading into 2022, riding these gains high.
Well, and what is going to be the driver in 2022, Christine? Does monetary policy ultimately matter, or is it all going to be about earnings and more specifically forward earnings expectations?
Well, Kailey, I think that will be part and parcel of the same story, right? In terms of what we see in monetary policy is probably going to be material for how that plays out into companies' outlooks when it comes to their earnings. And yeah, I think it's very much front and center. It's been flagged, potential monetary policy mistake has been flagged as one of the biggest fears that investors have heading into next year, along with inflation. And all this probably will have such a great bearing in terms of whether companies can squeeze more profits into 2022, knowing that that punch bowl that the Federal Reserve and other big central banks have given markets for the good part of the last decade will start to get drained into next year.
And of course, we've already gotten that signal, right, Christine? The Fed has already said it's accelerating the taper. It has indicated it will hike multiple times next year, given the dot plot. And yet that didn't really seem to shake the market. So what is going to be any kind of downside catalyst that we could see in the year ahead, as more and more people seem to be calling for a correction at some point?
Yeah, I think that's really interesting, Kailey, and I think you're absolutely right. Markets haven't really necessarily believed that the Fed is going to be able to do their 3 rate hikes that Jay Powell had indicated when we heard from him a couple of weeks ago. And I think that's part of the reason why we're heading into the end of this year on these gains and these highs as well. And so in terms of downside catalysts, I would be very interested to see how markets digest the Omicron situation and how that really plays out. And whether the initial negativity that we saw heading into December, when we were seeing more news of lockdowns of various countries, if that comes to bear fruit into 2022, or is that something that investors realize, oh, maybe we overreacted at the onset with the sell first and ask questions later sort of attitude that we saw, and perhaps there's room for a bit of gains there heading into next year?
Yeah, we have heard from some analysts that there's not a lot of news yet that Omicron has hit the economy in a negative way. Does that make sense to you?
I think that's very much, sensible. I think it's really too early to kind of see concrete, real economy impacts from the situation, especially because it still is very much playing out. I think as far as kind of longer term impacts on growth, we'll probably have to look at the state of various lockdowns and how long that lasts, or how much more they get stepped up in various countries. In the UK, for instance, we're still waiting on whether there will be new restrictions in the new year. So far, we've heard from Boris Johnson's government that there's not going to be any heading into the new year. But, businesses are still very much bracing for that. And so, yeah, I think that will take a while for those effects to play through to the real economy. And so I think it very much makes sense that at the moment, we're not necessarily seeing solid impact or evidence of the Omicron effect in the economic data so far.
Christine, does the drop in Bitcoin mean anything to you? You can say no if it doesn't. We're hearing from some people, I mentioned Ben Emmons earlier, that this could be a little bit of unwinding of leverage into year end, but it doesn't seem like there's a real catalyst for the move.
Yeah, look, Matt, I am far from a Bitcoin expert, but what I can say is that this feels very much like exactly what you said and what Ben Emmons described as well, is a bit of taking risk off the table heading into next year. I mean, Bitcoin has been flagged in many a year-end survey among clients and investors as one of the frothiest asset classes that could potentially be headed for a bit of a correction into 2022. And while there is no necessarily a fundamental catalyst that we're seeing behind this particular move, I think it makes all the sense in the world that we're seeing a bit of a climb down here, especially from staggering levels that we saw earlier this year.
Yeah, there's a question of how much fundamentals really matter for Bitcoin. Maybe it's more about the technicals. Thank you so much to Bloomberg's Christine Aquino for all things markets with us today. Now let's get back to some individual equities moving in pre-market trading here in the U.S. And I want to begin with Tesla. Elon Musk selling more shares, this time equivalent to $1.02 billion, getting very, very close to having entirely offloaded that 10% stake that Twitter told him he should do. So right now, Tesla shares are up about 2.5% in anticipation of maybe all of that selling being over. To the downside, though, I did want to mention one particular stock, and that is the Runway. Of course, this has only been a public company for about 2 months. It IPO'd at $21 a share, and in pre-market trading this morning, it's only at $7.50. This is after the company fell 10% yesterday. The stock fell 10% yesterday. It's down another 7% or so in early hours this morning. Maybe the idea that the stay-at-home world beneficiary, not so much right now. And then another stock I wanted to mention is Moderna, of course, the COVID-19 vaccine maker. Yesterday, it officially had lost about half of its value since its record high back in August, and those losses are continuing this morning. The stock down about 2.25% before the bell. This vaccine maker weighed on heavily, Matt, by the idea that more therapies like the pills from Merck and Pfizer may actually dent some of the need for these COVID vaccines, Matt.
All right, very interesting stuff. I think there's a lot actually going on today. Coming up, there isn't a lot going on in terms of stimulus. Bloomberg opinion columnist Marcus Ashworth shares his view on central banks in the year ahead. What should we expect from the Fed, the BOE, and the ECB? And more on the markets with Lothar Mentel later, Tatton Investment Management Chief Investment Officer. He says we could continue to see gains, plus an update on Omicron with Dr. Andrew Pekosz of Johns Hopkins University. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Kailey Leinz in New York. The gravy train is slowing down for equity investors. That's a prediction for 2022 by Bloomberg opinion columnist Marcus Ashworth. He sees central banks in the developed world, including the Fed, starting to take back the massive amounts of stimulus they pumped into economies during the pandemic. And he joins us now to discuss. So, Marcus, is this a case of tapering or absolutely stopping purchases or even unwinding balance sheets?
Well, I think it's going to be the most interesting thing of 2022, obviously, with the fight with inflation, will be quite how the central banks who have promised that they're going to do these things. The Bank of England had a little go at hiking interest rates. They're stopping adding QE. If they hike again in February, they'll automatically kick into what's known as quantitative tightening, in the sense they'll be actually letting their balance sheet drop. Now, that's a big experiment, like a double measure of tightening if that happens in February. So, the Fed are going to be right close behind. We know they're tapering more aggressively. They'll stop adding new purchases in March. The possibilities they may match that with a rate hike. This all sounds great. We've had so much stimulus the last year or two, but can the markets handle it? Can the Fed and the Bank of England, etc., allow a stimulus to drop, just as fiscal stimulus, which was the great cavalry that turned up? We are seeing troubles with Biden's bills to get through Congress, and there's no doubt about it, the UK government definitely are going to fiscally tighten. The more fascinating one to me is the European Central Bank, because already you look at where the Italian bond spread is against over Germany, it's widened, despite, I think, ECB being about as dovish as they could get, in their December meeting. So can the ECB even moderately try and reduce the amount of what they buy each month? Doesn't seem like they're getting away with it at the moment. So the first real test might be on Europe's door.
So how much are they actually going to tighten fiscal conditions? I'm especially focused on the U.S. here. If you type up FCON, you still see that they're pretty loose. Do you see that really turning around past the zero bound?
That's exactly the right thing to be watching. It's that financial conditions index, because that starts to tighten more than the Fed wanted to, and it starts to hit the economy and indeed, therefore, the stock market. Then the Fed's going to have to slow its whole timetable right down. Now, clearly, tapering is a very good idea. It shouldn't have been adding the ridiculous amounts, 120 billion a month it was adding for the last, few months, years. It's just been, too long and too much. So that's fine, but they need possibly, I think, to wait for a bit before they start hiking interest rates, certainly more than once or twice. I think exactly the same for the Bank of England. I think they may get to their second rate hike and think, you know what, we're going to have to wait around a bit here for another few months. And it's clearly that would buy the European Central Bank time. But the Fed, as ever, is the one to watch. And the financial conditions in the States really sets the benchmark forever around the world. And the point here is that the economies may not like it very much. We may see some dipping off in growth, but it's really whether inflation continues to rip higher, it puts the Fed and all the rest of the central banks in a horrible situation. They may have to hike interest rates to curb inflation, even though it kills the economy. It's a very difficult balance.
So, Marcus, are you of the opinion that the Fed could be about to make a policy mistake or that it has already made one?
I think the Fed is walking a very fine tightrope. I think they're doing perfectly well. Look, I think they definitely put too much stimulus in. That was the policy error. That now makes it more likely that they'll make a policy error the other way. I think that the Powell is very smart. I think he's done as well as he can. And I think that the Fed won't hike as much as some people are predicting because they won't be able to. Because I don't think they want to break the economy by hiking like they did perhaps in 2018. They had to stop everything, reverse everything. I think they've learned their mistake and they'll be very careful this time. Still, direction of travel, definitely tightening, just maybe quite slow.
And as you alluded to, it's not just now monetary stimulus unwinding, it is also fiscal stimulus waning in a really big way. What does a world that is past both fiscal and monetary stimulus, the peak of it, look like?
Well, it doesn't seem to look too bad. If you look at the stock markets that's at all-time highs, at the moment, companies have found some real great pricing power through the pandemic. They've been able to make some decent profits. That's reflecting in higher stock prices and better credit spreads. So at the moment, the corporate world is doing perfectly well. But like we know, the stock markets decide to turn south. It could change things very quickly indeed.
All right, in terms of gains, we've had huge gains over the last 3 years in a row, Marcus, and we're at valuations that are still pretty eye-popping. I think 26 and change is the PE on the S&P 500. Does it look like investors are less willing to give high valuations to earnings and buybacks next year?
No, I think the gravy train is still rumbling on. I think things are set reasonably fair for equities and for credit spreads. I do think there'll be some trouble in government bond yields, but we've got a decent start to the year ahead of us. I think the question is whether it can sustain. I don't expect the gains to be as big as they were last year, but I still think it'll be an okay year until and unless something horrible happens. But for the moment, I think the economy is probably set fair. There's so much stimulus in the system that as long as central banks take it carefully and withdraw that in a careful and steady manner with very clear signaling, then I think things are probably okay because the economies have had so much stimulus and are set so fair. However, inflation is the evil thing, which can upset the apple cart very, very easily.
Inflation is evil. Thank you so much to Marcus Ashworth of Bloomberg Opinion. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Matt Miller in Berlin. Now let's get the first word news. And there's more evidence that the fast-spreading Omicron variant leads to milder symptoms than other strains of the coronavirus. The U.S. surge appears to be triggering a lower rate of hospitalizations than earlier waves. The number of people hospitalized hit a 7-day average of just under 9,000. That's half the peak that was reported last January. In China, the economy expanded at a moderate pace in the final month of the year. Car sales rose faster, factory inflation pressures eased, and business sentiment improved. But the slumping property sector and slowing external demand are clouding China's outlook. December's Richmond Fed Factory Index topped estimates, rising to 16 from 12 in November. Backlogs of new orders reached the second highest on record as vendor lead times stayed high and inventories remained low. And Apple is paying some engineers unusual bonuses of up to $180,000 to keep them from leaving. Bloomberg's learned that the stock awards are going to some employees in silicon design, hardware, and select software and operations groups. The Apple shares vest over 4 years. And Matt, I feel like one big theme we've been focusing on this year is the competition for talent. That's been evident in the financial industry with one-time bonuses, higher starting salaries, you name it. And we've talked a lot about how the banks aren't just competing with each other, they're also competing with technology companies, and technology companies also have to compete with each other on that front.
Yeah, we have, on the terminal, we have a great chart showing the job openings. You can see it if you type in EcoGo or just look at the JOLTS. It's been amazing. This, I think, is especially interesting because these are shares that are restricted and they vest over 4 years. So if you're an engineer and $180,000 is a huge chunk of money to you, you're less likely to leave the company, obviously, because you don't want to lose those shares. Then you're not going to go to Meta. Then you're not going to go to Twitter or wherever you would leave Facebook or where you leave Apple for. So I think it's a really interesting strategy, and it must have been a welcome Christmas surprise to a lot of those employees.
I'm sure it was. And of course, this is something that realistically you would think Apple can easily afford, given it is now worth almost $3 trillion, not quite at that level, but very, very close. And it obviously has a massive cash pile that it is working with. It's been using a lot of that for buybacks, but now clearly it's not just giving money back to investors, giving them to employees as well, Matt.
All right, very interesting stuff indeed. Later today, by the way, speaking of Apple, we're going to talk to Apple bull Dan Ives of Wedbush. We'll talk we'll talk about the $3 trillion valuation and other tech in 2022 as well. That's at 8 a.m. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Kailey Leinz in New York. Anna Edwards is off this week. Now, we had a little bit of a reversal of the rally yesterday, Kailey, although it had been a nice, solid 4.5 sessions leading up to that, a little bit of a Santa Claus rally. And I saw some pretty interesting data from the Richmond Fed that made me happy. We see finished goods inventories up to -6 from -23. So the upshot of that is it looks like maybe we're going to see cars and trucks back on dealer lots soon.
The only thing Matt Miller really cares about is what car he's going to be able to purchase when he moves back to New York in about 2 weeks. But Matt, to your point, we did see a little bit of unwinding of the rally, at least here in the U.S. yesterday. It was only 0.1% decline on the S&P 500, so we are still very, very close to record highs, and that's the case both in Europe and here in the U.S. In Europe, the stock 600 is up a little more than 0.1% at 489.19. That is within a point of an all-time high, so we'll see if we can reach it by the close in the European session today. Now, of course, before the U.S. session opens, we have about 4 hours to go. Futures are in positive territory. We're up about 0.2% to 47.87, still within spitting distance of that nice round 4,800 level. In the bond market, not a lot of action. We are up a single basis point on the 10-year Treasury yield. 149.28 is where we sit, so we remain sub 150 as we get closer and closer to year end. And then, of course, we talked about Bitcoin earlier. Saw a pretty sizable decline yesterday. This morning, trying to gain a firmer footing. Right now, we are trading just below $48,000. As for some movers to pay attention to in pre-market trading, we have to touch on Tesla again because Elon Musk is almost done selling off that 10% stake, sold another $1.02 billion worth of shares overnight, and that stock is up about 2.25% as a result. I also wanted to mention some of the COVID-19 vaccine makers. CureVac actually hit a record low yesterday, so maybe just a small amount of dip buying is coming in today. That stock is up about 0.4% before the bell, but not so lucky for the likes of Moderna, which already has lost half of its value since its record high back in August. It's down another 2.3% this morning, and then Novavax is also lower by the better part of 1%, Matt.
All right, I am watching, Kailey, the juxtaposition between the horrible Omicron infection data that we're seeing and that manufacturing survey I was just talking to you about. Here you can see a chart, and for those of you listening on radio, I will say good Wednesday morning to you. You don't see this chart, but you know what the Omicron infection story has been like. Just rising to, yesterday, almost 1.5 million new cases globally. Today, another million and change added to that. So 2 days in a row of more than 1 million new infections. globally with the coronavirus of some sort. Most likely it's the Omicron variant. Pit that against the Richmond Fed manufacturing survey. We had the number come out, the headline number at 16 compared to the 12 from last month. Analysts that we were talking to, economists that we surveyed, only expected 13. When you look at deliveries there, they're up to 12 from 0 last month. So it looks like there's a normalization when you go to the data. Lothar Mentel, Tatton Investment Management Chief Investment Officer, joins us now out of Bochum. Lothar, good morning to you. Thanks for your time this morning. What do you think about the possibility of an economic normalization, the reopening we've been talking about, versus this huge jump in Omicron infections?
Well, that's certainly a short-term headwind at the moment, because at the moment, where I normally live in the UK is once again the big test bed for the world. What happens when a relatively highly vaccinated population is being hit with this hugely infectious variant? And at the moment, at least, it looks like hospitalizations aren't quite as bad, but the numbers are high. So I think the world is watching. And at the moment, things are in the balance where they will throw another spanner short term into the works of normalization, which is definitely going to happen over the coming year.
Well, and when we think about the risk posed by Omicron, do you view it more as a growth risk or as an inflation risk? And then how would that inform your view as we move forward?
Certainly more as a growth risk. It would, for the shorter term, put more of a dampener on inflation. If people can't actually go out and spend their money, go traveling, do this and the other, then that obviously puts a dampener on demand, and therefore should drive down the inflation pressures that we've seen recently. It's more of a growth issue. If people can't go and produce, can't spend, then all of that isn't great for growth, and particularly with a view to China at the moment. If China keeps trying to fight the pandemic just by shutting down everything, then that could be bad news for the Chinese economy at the moment as well.
Yeah, China firmly sticking with that COVID zero policy. Matt, sorry, did you want to jump in there?
Well, I was just, mentioning China and their economy. They have pledged more and more targeted stimulus there. Do you expect that to be a lift for 2022?
It should be, but most certainly not as much as we've seen in the past, when really Chinese growth has pulled the world economy along. That we still can't expect. But as the Chinese government wants to wean off the public of that addiction to property values and perhaps get them more into the broader capital market for their savings, they certainly need to do something to lift the sentiment at the moment, because as we've just seen from the latest data, consumer sentiment is not great at the moment in China, and I would very much ascribe that to the pressures on the property market, which are currently driving consumer sentiment, because you feel poorer if those values aren't going up as fast anymore as they used to.
Well, and obviously, as China tilts in the easing direction, most of the other major central banks around the world are tilting more in the tightening direction. When you think about kind of regional investment and allocation, how does the divergence in central bank policy inform that for you?
Yes, that's a very important and interesting point. But I think if and when inflation pressures are subsiding somewhat because of this latest wave, then there will also be less pressure on the central banks. And quite frankly, at the moment, we observe that the general equity market sentiment seems to be more driven by real yields rather than nominal yields. And on that front, actually, this whole development could be good news for keeping real yields relatively stable, and therefore the environment in the equity markets still very much geared to actual profit growth rather than that threat of rising yields making the current valuation levels unsustainable.
Well, and obviously when we think about relative value in those higher yields, you'd think it's those stocks that enjoy much higher, loftier multiples that would be hit by that, aka growth. If you still think real yields will remain low, why then do you see more favor toward the cyclicals in the year ahead?
Because we are going to see that gradual normalization as this pandemic is starting to peter out through less virulent, maybe more infectious, but less virulent mutations. And that all tells us that, just like always in mankind, it seems to take 3 years for these pandemics to become endemic. And that's what we're seeing ahead. And with that, then comes a return of demand for those things that are more cyclically driven, be that travel, be that bank lending, all these things that are more on the cyclical side should benefit in that environment and really move ahead. So we believe that 2022 will be more a story of rotation rather than general stock market upsurge as we saw in the last years.
And maybe less demand for safe haven dollar, Lothar. I saw an interesting chart earlier, and I think Kailey put it together for me on U.S. Leveraged dollar assets. They're bid big, and the dollar has been really strong into the end of this year. Of course, you've also got the Fed tapering and then raising rates expectedly next year. Do you think investors are front-running that and buying up the greenback now? Do you expect the dollar to rise more in 2022?
Well, first to say, obviously, the dollar is very crucial for the global economy, particularly emerging markets could really benefit from a slightly weaker dollar. And that's not what we got in 2022. Looking forward, though, now with Biden's Building Back Better program having become somewhat unhinged, we could well see a bit of less growth impetus coming from the US, perhaps really a slowing in momentum there. And in our experience, that's really then what drives the dollar. In this case, I wouldn't expect it in the first quarter to be driven up higher if the US comes off the boil slightly and perhaps Europe with its bigger stimulus program in the shorter term takes the lead.
I'm looking at the yuan as well. Over the last year, we've seen the yuan really strengthen, but if the Chinese pursue a weaker yuan policy, we have a viewer writing in and asking, how much does that hurt the EU recovery picture? I.e., how dependent is the European Union economy on China?
Really good question. And obviously, the European export industries are very much dependent on China. But at the moment, we also have the Chinese central bank really loosening again on the monetary side. We discussed it earlier. They really need to prop up consumer sentiment, and that's going to weigh on the yuan. But I think for Europe, in the shorter term for next year, it will be more important what can be done on the domestic demand side. And here, the European stimulus, the EU stimulus program will be quite important. How much of that can actually be put forward, and how much does business and industry anticipate that to happen and spur credit demand and therefore domestic demand across Europe rather than being so dependent on Asia?
All right, that is a really interesting point. This is why it's great when viewers write in with questions, because I don't think of these things. Are European exports key? Lothar says, you know what, maybe domestic demand is more important to the European economy. Lothar Mentel there of Tatton Investment Management coming to us out of Bochum. He is normally in London, but great to get him while he's here in Germany. Coming up, Andrew Pekosz, Johns Hopkins Bloomberg School of Public Health professor and virologist, talks to us about the pandemic maybe becoming endemic. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, Jim Paulson, Leuthold Whedon Capital Management Chief Investment Officer. That's at 8 a.m. in New York, 1 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Matt Miller in Berlin. And Matt, unfortunately, there is no sign that the pandemic is slowing down. For the second day in a row, the number of coronavirus cases around the world was over 1 million. But overall, the Omicron variant appears to be triggering a lower rate of hospitalizations than earlier outbreaks. Joining us now for more is Dr. Andrew Pekosz, professor and virologist at the Johns Hopkins Bloomberg School of Public Health. Dr. Pekosz, a lot has been made about the lower hospitalization rate. The ratio of people who are infected versus those who go into the hospital seems a lot lower than previous variants. But if there's a larger number of people getting infected, doesn't the numbers game indicate that actually you will still net end up with more people in the hospital?
I think that's absolutely correct. To think about it in a simple way, a virus that causes half as many hospitalizations but causes twice as many overall infections will end up with the same number of people in the hospital. And one of the things that's been difficult to assess with Omicron is how much pre-existing immunity in the population is really dampening the disease potential for this variant. We still haven't seen a large number of infections in unvaccinated people and in individuals at high risk of severe COVID. And that's really the thing that I'm looking for, is to see those numbers. Will Omicron be just as severe as Delta or previous variants in those high-risk populations or in those unvaccinated populations? It does seem to be milder in the vaccinated populations, although it is causing symptomatic cases.
Can I just jump in and suggest a little bit more optimism? Because I saw the New York hospitalization number today, and at first I was alarmed. It's the most that we've seen in New York State sent to the hospital in one day since like the middle of 2020. On the other hand, if you look at the absolute total, we're still at less than a third the peak. I think we had 647 new hospitalizations in New York yesterday. That leads us to a total of 6,173 COVID patients in the hospital. At the peak last year, we had over 19,000 people in the hospital with COVID-19. So it seems like we're far from the horror of 2020.
I think that's partially true. I think the other thing we have to think about is the fact that the cases that we're seeing last week and this week, the severe cases resulting from those infections won't start coming in until end of this week, beginning of next week, because there's a delay in the hospitalization rate numbers compared to the case numbers. So it's really going to come down to, again, how severe this infection is in both the vaccinated as well as unvaccinated populations. And that's going to judge the surge that's going to be coming at the end of this week and next week that's coming from this sort of new Omicron cases.
Do we have any data as to whom this is hitting hardest? I have seen reports that more children are being hospitalized, and that's obviously has a much bigger emotional impact.
Yeah, and I think that represents a population here in the United States in particular where there is very little pre-existing immunity. Kids, particularly under the age of 5, but even kids under the age of 10 or so, haven't had a high vaccination rate. Some of them are not even eligible for vaccines. And previously, they haven't been hit really hard with COVID-19. So they represent a population where there isn't a lot of pre-existing immunity and therefore are probably more susceptible to especially a transmissible virus like Omicron. And again, we're going to keep our eyes on the elderly, particularly those over the age of 75, as well as immunocompromised individuals, to look at the disease severity in those populations.
Well, in talking about pre-existing immunity, doctor, this is kind of a two-pronged question. A, it doesn't seem to matter if you were infected with Delta or Alpha, one of the previous variants, when we talk about Omicron specifically. Is that really true, part one? And part two, if you did have one of those prior variants, if you maybe have some form of long COVID, is there a risk that being infected with this Omicron variant actually becomes a much more severe kind of case?
Well, Omicron seems to be raising the bar when it comes to the type of immunity that's needed to protect you from not only symptomatic infection, but also presumably from hospitalization. So previous infection alone, or even the regular vaccination schedule, which usually is 2 doses of the mRNA vaccine, seems to be not enough to protect from symptomatic infection. What you need is that 3rd dose, that booster dose of a vaccine, or if you've been infected, you need to get at least 1 dose of the vaccine to really get your immunity up to a level where you'll be limiting the numbers of symptomatic infections in that population. So Omicron is raising the bar on the immunity that's needed to limit its spread, and no longer the regular vaccination protocol, nor the fact that you were infected before really provides you with enough protection from symptomatic disease anymore. You really need to have a booster, or if you've been infected, you need to get that at least 1 dose of vaccine to really boost your immunity to high enough levels to provide protection against Omicron.
And I guess the logical follow question on that is, when does the boosting cycle stop? Unfortunately, that's all the time we have right now, but thank you so much for joining us bright and early this morning. That is Andrew Pekosz of Johns Hopkins. And coming up, Bitcoin is set for its worst monthly drop since May. We'll hear from the CEO of crypto exchange CoinList next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin. We are keeping an eye on crypto-linked stocks as Bitcoin heads for its biggest monthly drop since May. CoinList CEO Graham Jenkins spoke with Bloomberg's Romain Bostic, Tim Stenovich, and Kriti Gupta, saying that over the long term, Bitcoin is still, in his opinion, a superior asset in which to invest.
The arc of history is long. And Bitcoin at the start of the year wasn't doing so great, and it's actually kind of over the course of the year increased pretty nicely. So there's lots happening in the world. Who knows day to day? But I think over time, Bitcoin ends up being a pretty superior asset to invest in.
Yeah, and this is obviously a world that it goes much further beyond just Bitcoin itself. And when you talk about, I guess, all of the various use cases for it beyond just as a speculative asset here, how far along are we in that process here with regards to the way people use this and utilize it rather than just say invest in it?
Yeah, for sure. It's I think what's not really that clear to the world at large, to the mainstream, is that what's really happening with Bitcoin, with Ethereum, with this whole bucket of technologies, blockchain and cryptocurrency, is that there's really a revolution in software development that's happening. Blockchain technology represents a totally new way to build, distribute, and run software, potentially running it indefinitely. And all of the software verticals that were built over the last 20, 30 years through the internet age, whether it's search, e-commerce, social, all of those verticals are being attacked by blockchain, cryptocurrency-based applications. And we're going to see that continue not just through 2022, but beyond.
Talk to us a little bit about how you market to an individual that is still concerned about that volatility. Yes, you can make these massive gains, but you can lose them too. And a good chunk of the essentially new investor base, the newest generation entering the world of investing, well, they're not necessarily looking at just stocks. They're looking pretty primarily at cryptocurrencies. How do you market to someone who might be the polar opposite of that?
Yeah, that's a tough one. Well, I mean, I think part of the way to talk about it might be in terms of talking about the price of the US dollar and how that's changed over time. I think a lot of people focus on Bitcoin price, but there aren't as many people that focus on the price of the US dollar. At one point, USD bought 100 Bitcoin. Now 1 USD buys 0.00002 Bitcoin, and it continues to decrease in value. So I think that's part of the way that you tell the story, especially with respect to Bitcoin. You're talking about an asset that is somewhat inflation resistant, at least over the long term. So I think that's a good way to talk about it.
That was the CEO of CoinList, Graham Jenkins, speaking with us at Bloomberg yesterday. Now, a quick check on the markets after the Santa Claus rally kind of petered out yesterday. We see the Stocks Europe 600 index up to 489.30, so getting close to an all-time record. S&P futures up again, so if we finish up here, we could see a 70th record for 2021. Brent crude unchanged, NYMEX is unchanged as well. Bitcoin up currently, but still under 48,000 at $47,666.17. More Bloomberg Surveillance is ahead. We'll hear from Sarah House of Wells Fargo, as well as Super Tech Bull Dan Ives of Wedbush. Jordan Rochester joins us from Nomura, and Baki Hansadi at Johns Hopkins on COVID. This is Bloomberg.